We're joined by Sandy Gross with Pinetum Partners, also media and technology editor Dennis Neal. Sandy, let me start with you because, I mean, how do you deal with this issue? Do you spread the pain out throughout the whole entire bank? You end up punishing some people, you know, that didn't lose money on the year? Do you, risk losing talent in the group that did lose a lot of money? How do you think you should deal with it to retain the best talent?
Right, I think that a lot of the companies have to look at spreading out that risk and that liability to retain employees in the good times and the bad times. You know, most of these companies want to maintain their multi-strategy efforts, be able to provide different types of services and investment strategies to their clients. And over time, whether it's a startup strategy or one that's been proven over time, you are going to hit bumps in the road. And I think that to show your commitment to that multi-strategy effort and to the diversification, in particular a bank, you want to somehow try to level out that pain, as it may be, over the time.
Yeah, I mean, Dennis, why do you want to retain people who lost a bunch of money for you anyway? I mean, why punish the other people and still continue to pay the people who lost money for you?
Well, a couple things, Melissa. I mean, first of all, you stick with the devil you know. A guy messed up. That doesn't mean he's a horrible trader. It means that at one of the worst times in the credit markets, he managed to make some wrong bets. But then to actually wipe him out, pay him severance, do a buyout, and have to go find a new stranger who could come in and have the same bad luck at a bad time might not be the wisest move, right?
Charlie, do you buy that argument?
Kind of. I mean, here's the thing. I want to make one point about Merrill Lynch. What a lot of the fixed income people are telling me at Merrill Lynch is that the losses were generated from one small part of the fixed income department, the department that warehoused all those CDOs. What they were doing was they were underwriting these mortgage bond deals. They couldn't sell them to investors because the prices were going down. They would warehouse them on the balance sheet. That's where they're taking the big write-downs, and they're saying, listen, traders did pretty good. A lot of the other places did pretty well, so we shouldn't be feeling the pain for them. I will tell you this: Wall Street is pretty efficient when it comes to this. It's easy to lay people off. You don't pay them. You don't pay them a bonus. You saw that 78%. Those guys are gone. And yeah, you might give them a little severance. Wall Street takes it on the chin for a quarter, but in the long run, you do save money from getting rid of people.
Melissa, there is an interesting issue that arises here. You know that old saying of Benjamin Franklin, I think it was, we better hang together or we shall all hang separately. One wonders where, so fixed income had a bad year, yet they had other great years. A rising tide lifts all boats. There are some companies, I think GE might have done this with senior execs, don't let your bonus be based only on how your department does, because then you will think only in terms of your department and think instead of thinking of the company. Maybe instead bonuses should be more of a reflection of the entire company.
Well, wait a second.
And let's face it, a lot of these Wall Street companies are doing badly.
This isn't a social. We're not talking about Sweden here. This isn't a social.
It's not social, but you're creating a culture and an environment where you want collaboration and you want other groups to support each other and to share best ideas as well.
With all due respect, Wall Street is a meritocracy. You get paid on how well you do. You don't get paid when you don't do well.
But
and
Sandy,
that's what's going on here. And I'm telling you, listen, there is a point to be made here. There's a broader point. I don't want to get lost here. The fixed income traders are complaining that they're taking it on the chin for one small part of the firm. That's their complaint. But overall, when you think about it, if you're in Wall Street and you have a lousy year, you shouldn't be taking money from people that had a great year. That's insane.
Sandy, isn't the bottom line, I mean, if you get $1 less this year than you did last year, you're going to be annoyed. You're looking for a different job. You may go to a hedge fund.
You may go to a hedge fund, but not all the hedge funds have done that great either. But I think with the hedge funds, they're mostly private companies. They're not reporting quarterly returns. So maybe they can ride the tide a little bit better, look at some of the trends, take their time as far as getting rid of strategies or getting rid of people. The people are the ones that are going to make the company. And I think that they're really tied to the folks in those funds. And they are committed to creating a multi-strategy effort to meet the needs of their clients.
Dennis, if you're saying stick with the devil that you know, I mean, aren't you looking at them and going, hey, wait a second, Goldman Sachs found a way to hedge this bet. They found a way to short subprime. They ended up making money. You guys didn't figure that out. I don't know that I want you on my team anymore. Why am I going to pay you to stick around?
Well, first of all, the guy who's making that decision, I mean, he should have fired him before they screwed up, not after. Maybe that guy who made the decision should be fired. Second of all, Goldman, they did lose $1.5 to $2 billion, right, in other areas. Okay, it's just that they offset that with some good bets. And were they smart? Did they get lucky? Goldman's got, what is it, Charlie, $17 billion reserved for bonuses. They're certainly spreading the wealth.
By the way,
but anytime someone's going to threaten to leave, I think that sometimes you got to be willing to let them leave. You can't let them hold you up for money. And some of these firms just don't have the money to pay out the bonuses, and their shareholders would be mad, right?
Charlie,
if they
real
paid
quick,
out
last word, real quick.
Merrill Lynch is doing exactly what Dennis is saying, spreading out the pain to the entire firm when just a small part caused it. That's why there's so much dissension. That's why that is the least meritocracy. I can't say the word, but it's not meritocracy when you basically spread out the pain when one small part of the firm is to blame for the whole mess.
Okay, Sandy, Dennis, Charlie, thanks to all three of you for joining us.
Thank you.